Okay, all right. So guys, a quick introduction to the group. So we are the Global Value Investing Club, operating in multiple cities. We are going to do another session in Malta at the end of the month. And one big thing from our side is, as you guys know, I run City Falcon. That's my baby, my company. And then Dimitrios, obviously he's been presenting before, and now he's officially joined my company. So it also helps to build the network, and so I'm glad to have him on my team. So we are started. So the club is growing. We've got 6,500 members. Now that we are a bit more comfortable with webinars, people can join us as well. And we are hoping to grow it further. Just for the newcomers, like the presentations, and also we are recording the webinar. We put most things up on our website. So cityfalcon.com/meetup. So if you guys want access, or just email me if you need access to something. Our previous recordings are also there, available. We are trying to put it up on YouTube and other places like TradingView, for example. So you guys have access to that. So everything that we discuss, again, for newcomers, we put it in an Excel sheet, Google Sheet, so you can track it. We need to update it with recent prices because it's been quite volatile. So you can have a look, you can see ideas we've discussed, the presentations. If you want access to something you can't see, just reach out to us. So you can see what was the logic of someone recommending it 2 years back, and maybe the price is lower now, so there are opportunities for you guys. So obviously, I'm speaking here, but the idea is not that it's a speech, but it's interactive. So what I want to discuss with you guys is, so this is S&P 500. Let's use it as a proxy of what's happening in the markets globally. And obviously, we've seen a lot of volatility, and it went to 3,500. By the way, how many people here track S&P 500, just out of curiosity? So most people, right? And so it went to 3,500, and now it's back to 4,000 because the inflation numbers in the US were not as bad. And so that's kind of recovered. One interesting thing I keep a track of is where it was just pre-COVID. And if you look at that, that was quite close to 3,500, maybe 3,300 or something. And we reached that level, and we've kind of gone up there. So that's kind of interesting. So thoughts from people, just an open floor. What do people think from here? Is there more pain left, or do you think it's the bottom? Thoughts? More. And why do you think more pain to come? Yeah, because there are guys on the webinar as well.
Everything, issues, inflation, interest, just more market disruption. I think there's too much unrest. This would be the bottom.
Yeah.
Everything's unsettled. We shall see. Well, it depends on what central banks do. I just think.
So you would recommend what people are doing, buy on every day? No. Okay. Anyone else? Thoughts?
So first of all, I think it depends what you mean by pain. So if pain you mean by the financial sector, it depends from two components. Well, yeah, the expectations of inflation, and interest rates. Sorry, not inflation, interest rates. But also what are the expectations about the earnings? So you might have obviously a fall in earnings from a general perspective, and you will have obviously a concurrent or consequential increase. Change in expectations about Fed people. So you might have in the next, expectations for the next 18 to 24 months. Market might expect that the Fed might go down with interest rates, slightly, or change the attitude, the stance, and the monetary policy. But then we need to see what the impact of earnings on valuations will be on models. If we talk about economic pain, well, that would be blood in the streets. But that would be no for this.
Anyone else? Okay. Yeah, sir.
be challenging maybe for a few more months, but one thing, the U.S. markets tend to do better with mixed governments, and now you have the midterm elections where now we'll have, well, a Democratic president, but maybe like a Republican Congress. So that's a mixed government, so that will support the S&P 500. But also markets tend to start recovering before the end of the recession, like ahead of time. So if you wait until the economic problems are over, you're going to miss the increase, I think.
Sure, thanks.
Yeah. All I would say is that inflation tends to go in like obviously peaks and troughs, and it's been a little bit of a trough, and it was under what people were expecting. So there's been a big bounce. But when you look at individual companies, I think there's been quite a few over the last couple of years that are way overvalued. So really, I view it as like this has been somewhat of a correction. The potential for it to go below that is still there over the long term, depending on obviously all the conditions raised, like higher interest rates and inflation.
Yeah. So it's a lot of good points and a lot of things to consider here. Obviously, if anyone knew the answer, we would all be millionaires. I'm sure some of you already are, but I'm not. Sorry, I should move here. So one of the things that worries me a lot is about kind of what is happening with the job losses, right? And this is we are not. It's also the highly skilled who are losing jobs, which is quite interesting, which we haven't seen before. So that market is completely changing. And when people are losing jobs, then it affects a lot of the consumption side of things, which will affect, retail companies, housing sectors where people are spending. So that's the bit that I personally feel we haven't seen the effects yet, because property prices are still high, not softened as much as you would have hoped. But what happens to the next iPhone when it's launched? How many of us are going to upgrade to the next iPhone? And I should disclose that I'm short Apple, so just so that you know. But I think those are the things to again consider. The elections, U.S. elections, of course. So there are a lot of factors here, which still makes me a bit hesitant of going all in. So I'm buying in small quantities and hopefully add over a period of time. So yeah. So one of the things I want to talk about, it's not completely value investing. It can be actually value investing in bonds. Anyone buying corporate bonds here? Okay, there's just one person, which is interesting because what has happened. So this is my portfolio right now, and I've put some numbers also. This is actual money invested, and I have bought everything from TalkTalk to Asda to Virgin Media, Iceland. So the companies that I think are less likely to go bankrupt, and companies that some of these are secured bonds, which means that if something goes wrong with the company, I still get paid. And it's very interesting, and I shared it in the email that I sent to you guys. I don't know if you saw, but the yield to maturity is incredible. So, for instance, I bought TalkTalk, which is my biggest investment there. So it's about 4% coupon. Okay, so this was trading last year about £100, which is the face value of the bond, but I bought it at £80, 80, right? So it matures in February 2025, which means that as long as TalkTalk doesn't go under, in 2025 I get £100 for my £80 that I invest now. Okay, on top of that I get the 3.8% yield. So the yield to maturity calculation, it's about 14% yield. Yeah. So, and then there are other companies you can. So Virgin Media, supermarkets, these are generally, I would say, less risky. But anyone knows why these bonds are going at such discount? Interest rates. Yeah, interest rates. So the yields changing, or people just not wanting to hold any kind of risky assets, and all of this is. And when the situation with Liz Truss happened, right, you could have bought them even cheaper, maybe £75. What I also started buying, and not on the personal side, but on the company side, where I can take less risk, is UK Treasury, which also gives you 3.5% yield right now, which is great. But any thoughts on corporate bonds from people? Anyone? Is it interesting to look at? Okay. Yeah.
So you're going to get a yield to maturity of 14%, but we've just had an announcement today that said inflation is 14%, CPI, RPI, including mortgage interest, is about over 19%. So that means that if inflation continues to rise, you're actually holding something which has no potential upside and a potential real terms loss. How do you feel about that if that was there?
Where would you put your money then right now?
Into equities rather than bonds, which have the potentially upside, and a lot of things are yielding, north of 6, 7, 8, 9%, twice covered in terms of dividends.
Yeah.
And they still have that possibility to return to higher prices as well when the market recovers. So you're saying you're holding that till 2025, is that right? So you've got 3 years. You're assuming that the market won't make a massive recovery within 3 years, So I'm interested to hear how you feel about that aspect.
I'm not an expert in any of this. It's a personal view. So I mean, if your assumption is that it's going to be 14-19% each year inflation, because this is an annual inflation, right? Then you're absolutely right. We shouldn't put money there. But if the annual inflation is so high, that means the central bank will have to raise interest rates more, which means companies are going to struggle more. So I see a bigger downside to equity than to bonds. And this is why this is my kind of less risky investment from my side. But again, I don't know what's going to happen after that. And just to kind of also give you a sense about why I'm a little bit risk averse at this stage is also because I run an early stage company, so I don't have a corporate salary. So I have to be a little bit, it's my rent money that I'm playing with, to be careful. Any other thoughts on corporate bonds before we move on? Okay, so I just wanted to run through quickly one of the companies that we discussed in our webinar back in April, which is Cloudflare. How many people know this company? Okay, so let's say 50% of the people. So, I mean, as I had done on the webinar, and it's available, the video, if you guys want to see it, it's one of the companies that we use at City Falcon on a daily basis. I absolutely love the product. And this stock was trading at as high as $225 at one point, okay, which is now down to 56. My average purchase is about $49.50. And I've been tracking this stock almost on a daily basis, just to figure out the news and everything comes in. So now it trades at about 15 billion market cap, roughly, which I think is great value to get in. Okay, and I am going to ignore the current financials, which as a value investor you would look at. But what I'm really looking at here is the market opportunity for the company with what it does. So let me take you guys through this. So we know that cybersecurity is becoming a big thing, right? Because of the war. We don't know if we have another Cold War. And so, apart from the tanks, this is where a lot of the action would be. So this is the thing I showed last time also, and it's just getting worse right now with everything that's happening. So this is one of the biggest reasons I think if the product is successful, it can take on Amazon Web Services, which is one of the biggest products in the market. And AWS is something that we use, and I hate when I get the invoice at the end of the month because it's insane, their pricing. Okay, it's super expensive for what they provide. The cost, if I were to move to bare metal servers, which is have servers in my own office and not use the cloud, is significantly cheaper. And I'm sorry. My personal challenge is that my CTO has joined the Ukrainian army. So I'm waiting for the war to get over and he coming back and doing this rather than me trying to figure this out with my other developers. But it's something that we are exploring. A lot of companies are exploring. A lot of new services are coming out. But the point is that Cloudflare has built this infrastructure, which is great, which is something we use on a daily basis. And they are removing some of the costs that I would have to pay on AWS, because AWS charges for everything, right? And so it charges you for traffic, how many times it's been accessed, charges me for storage on top of that. So it's crazy expensive. So these guys are building the infrastructure that can solve this problem for a lot of companies. Now, their metrics are incredible. And what was really surprising was when they announced the results and they exceeded the guidance from the analysts, the stock still went down 25%. And then I started accumulating a little bit after that. But some of the numbers here, so 29% of Fortune 1000 companies are the paying customers. 95% of internet users are within 50 milliseconds. So what this means is that they have built this CDN network, a content delivery network, which can reach users around the world very quickly. So for example, my company's servers are in Ireland. If someone from Australia were to access that, I would already lose 200, 300 milliseconds for the data to transfer from Ireland to Australia. Now, by using Cloudflare, they have a server in Australia which replicates my data, and so that can be served within 50 milliseconds to people in Australia. And that's a game changer for us. And we do all of this, and my cost for doing all of this is $250 a month as a company to use this service, which is incredible. Sorry, was there a question at the back? Sorry, I can't hear you clear. There's a lot of noise, but...
Right. So my question was how much difference does Cloudflare servers being in other countries other than in the US or UK that reduces your latency? Because I don't know whether they have servers across the world. Do they have them in India, for example? Okay. And are they allowed to mirror data? Because they can't send data outside the country from. Right. Sure. Yeah. But it's increasingly becoming very.
Yes.
Ruben,
That is
please
there. So,
repeat
I'm
what
sure...
you said for the people, because when you were talking,
sorry.
they couldn't
Sorry,
listen.
sorry,
You
sorry.
say what you answered, if you want, like this.
Yeah. So, the question was whether they have servers outside of the US and UK big markets. So they do. That's how the CDN network works. And again, it doesn't have to be like confidential data, but it could be simple things like images on your website, or you have some videos that you have. And all of that can be distributed around the world. Then they have 76% gross margin. So a lot of that infrastructure they've already built. So as new revenue comes in, that goes to the bottom line, so the EPS can shoot up. And they've been growing 50% annually for the last 5 years. And they expect, so they're making $1 billion in annualized revenue now. This quarter they hit that number. The target is to reach $5 billion in 5 years in revenue. So this is, again, they claim that they stop about 126 billion cyber attacks a day. So that is the kind of stuff that goes on the internet. So these are some numbers. In the interest of time, it's in their investor presentation, but they've been showing growth in most metrics. So this is the slide that I focus a lot on, which is the market opportunity. So when they started in 2018, they're focusing on one market, and now they've grown a lot. So for instance, they've launched this R2 object storage, which is basically if you're storing like images, videos on the internet, if you're on AWS, it's quite expensive. Now you can work on R2 and it's significantly cheaper. And they are trying to make it easier for you to migrate from AWS, Google, and others to use this. So this is how big the opportunity is. Of course, the numbers are made up, but it's big. I don't know if it's 135 or 90 billion, whatever that number is. Just a bit of a plug in terms of what we have built recently. So we've just added, this is our website. You can track Cloudflare there. Insider transactions. So this is a map. This is a chart that shows the price of Cloudflare over the last 5 years. But they got listed in 2019, so it's not exactly 5 years. But you see a lot of insider sells. Those are the red bars. And then recently, it's not been as much. Very interestingly, the sell in March 2020 is most likely the 6 months expiry after IPO, when employees could start selling. And so they sold quite a lot. And you see the price has gone up quite a lot, but you didn't have a lot of transactions there. And now it's come down. Also very interesting is that I need to still check this data, but the management has stock options and the exercise price is about 100. So they didn't expect the price to fall so much. So they might have to change that or adjust that. So yeah, so this is Cloudflare. Just the same graph again of so I'm long Cloudflare, as I said. So my strategy is in technology, I'm long Cloudflare and I'm short Apple. And I've kind of adjusted for the beta. And right now I'm pretty much at zero profit because that's how it's going. But that's my strategy on this. Any questions?
I was just going to say you should know his brother works for Apple.
Yeah, but I don't think Apple stock price affects anyone's employment, so I think it should be okay. My reasoning behind shorting Apple is that it's a stock that's worth 2 trillion upwards in terms of market cap. Of course, there are a lot of cash in books, so the enterprise value is, but it's still too expensive for a company that is relying solely on iPhone. 80% of the profit comes from iPhone, and a lot of the growth that we've seen, like Apple has risen 100% for 2 years back to back, and that's crazy amount of growth for the company. So if you think about one, the valuation is high, so price earnings multiple, it's trading between 20 to 25, I don't know the exact number, and it's not growing as fast. So there's a good chance that it might actually show a decline this holiday season because, I mean, it goes back, right? I mean, people are losing jobs. Are you going to upgrade your iPhone again just for a slightly better camera, which is what they've been doing for the last few years? Of course, they can innovate more. And if that happens, then yes, it might be different.
So if you had to sum up what the competitive advantage of Cloudflare is, what would you say it is? Because I'm assuming it's something to do with the speed of data, like you're saying, and how would they maintain that over the long term?
You want to answer that? Or? No, I thought you said So I think I mean, I'm not a developer or an engineer, so if anyone here can talk a little bit more. I think it's the infrastructure that they've built, and that they built it at a level that they can afford to be significantly cheaper than AWS. Also, I think what happens with AWS, which is the biggest in the market, is they're subsidizing other businesses of Amazon. So there's a lot going on there. So I think I would say the infrastructure one, the product itself, because I use it every day. So if you were to launch a website, okay, go on there and with a few clicks, and it's for free, you can secure your website from security threats. You can cache your data. The site becomes really fast, and it's super easy to use. So I would say infrastructure, the product, and the pricing, I think, are the strengths of the company.
Just a quick question. Why didn't you short Amazon instead of Apple if they are the direct competitor and they have such high pricing?
It's just I've been so it wasn't a planned like an industry play that I did long and short, but I more did it on the valuation basis. So Cloudflare, I think, is undervalued, but Apple is significantly overvalued for me. I know I don't. Sure. I don't understand Amazon well enough. Amazon is a bit complicated with several businesses, so I haven't gone into. But you're right. I should have looked at it, but it was easier for me because Apple I've been tracking for a long time, so I understand. And it's like 80% coming from iPhone.
Do you not look at how much debt a company holds? You do.
I think it's minimal. I don't think it's quite big. So most of it is equity funded, but you can check. You definitely should check all that. I mean, my thesis is really the market opportunity, which is pretty big, and that's the focus. If you're doing more value investing, I would spend more time on it. I haven't, just been busy with work. So
I think it doesn't have a lot of debt.
I'm not sure, but I think it doesn't have a lot of debt.
It doesn't have a lot of debt, but we just need to confirm that.
In terms of the product offering for Cloudflare, it's quite similar to Amazon, I would say. So, the content delivery thing, the speed and everything, even you can achieve with the AWS as well. I think the main advantage with Cloudflare would be the cost thing. So, so currently they are banking on the cost, but now later on how sustainable that is and what like Amazon is using that to fund other further things. So that needs to be seen because Cloudflare will reach a point that they will increase their prices as well. And that's where things might turn out.
Yeah, absolutely. I think that is possible. The difference in pricing, just to explain what he said, if I were to use AWS, I don't know how much it's going to cost me at the end of the month because it's based on traffic numbers and it's super complicated to kind of predict that. Cloudflare, $250 unlimited traffic. It was a no-brainer for us to use that. In the interest of time, just one quick thing. If you guys want to use our website, we have a Black Friday sale on our subscription, so 50% off. And you get access to, if you're using Gold, you get access to even 1,000 sources without paywalls. So if you want to access that, it should be in the email as well. Yeah, that's it from me. So I'm handing over to Dimitros for others. And guys, I apologize. I might have to leave early for another engagement, but the man is managing everything. Yeah.
So now, guys, we will have Josh Higgins. Josh, let me say a few things for him. He's an investment analyst at BBB. He also enjoys researching and picking stocks, and he runs the Sunrise investment blog. You can go and check it. Has passed CFA level 2. And carries freelance work for investment houses and research companies. Thank you.
Thanks a lot, Dimitris. So just looking at the quote that was on the board before about being greedy when others are fearful, I think it definitely applies here in the case of ITV. This is a stock that's been slammed this year, about 60-70%, mainly due to current market conditions with, as we've already alluded to before, high interest rates, inflation, but also because there's been various news coming out about the company which has been unfavorable, although not a death sentence, which kind of brings me to the idea that this company has been grossly oversold. So as you can see, for those who you don't know, ITV is a television broadcasting business. It's well known around the UK. It pretty much reaches about 90% of the population, and it's also got international business lines as well.
Yeah. Let me test. It should work. Try now. Yeah.
Thank you. So just going over what we're going to discuss. So obviously we want to know what they do to give context, where the company currently stands financially and in the market as well, and specifically in television broadcasting, the outlook on the TV market, and we'll mainly talk about the threat from streaming services like Netflix, Apple TV, etc. And then where they're going in the future, what's their strategy, how they're going to survive. And then finally, the most important point is we're going to talk about how much the company is potentially worth, because there's no point in investing in something that is overvalued. And then we'll finally talk about some risks, and obviously I'll take questions at the end. So currently, and this is 2021 data, so it's slightly changed, but fundamentally the same. Most of their business is advertising. So specifically, they advertise through what you would call traditional or spot advertising. So that's basically adverts that you see on live television, for example. And they do this through their various channels, ITV1, ITV2, and obviously catch-up television as well. Then you've got their on-demand section as well, which is very much a smaller segment of advertising, but that is increasing with the increase in online viewing of programs. Second part is ITV Studios, which is a significant part of their future strategy, as the studio market is still in strong growth despite the decline in traditional TV. They produce programs for other broadcasters, and their clients are, of course, very familiar, BBC, Channel 4, and they also have international clients, and they even have clients that are subscription services, subscription-based streamers themselves, like Netflix and Amazon Prime. So they have some form of, I guess, anchor as to how well they're doing also. Then you've got the slightly, I guess, smaller parts of the business. So you've got streaming, which they're entering now. So they recently launched, well, I say recently, a few years ago, they launched BritBox, which is basically a platform in which non-UK residents, so people in the US, Canada, South Africa, Australia, they can watch traditional UK television, and that's called BritBox International. And then you've of course got BritBox UK, and you've got ITV Hub Plus as well, which is essentially a non-ad version of their on-demand streaming. And then finally, you've got direct to consumers. That's entering competitions. If you want to win a big mansion in Harrogate or Sussex, you enter those competitions. They make kind of a small part of their revenue from that. So where does it currently stand financially? Well, it's a £3 billion company, so not that big in comparison to others. It's yielding about 6.5%, and its payout has been confirmed for, I think, well, this month actually. And it's got an average payout ratio of about half of its earnings since 2012, if you take away, obviously, the effect of COVID, which is pretty good and kind of proves that it's going to be sustainable. And then in terms of their ratios, so they've got a PE of 6.5, which for those of you who aren't familiar or quite new to investing, that's very cheap. It's got a price to sales of 0.86. In other words, the amount of money it's bringing in on a gross basis is actually less than the company's worth or priced at the moment. And then it's got a price to book of 1.76. One thing to know about the price to cash flow, which is also a very important metric, its price to cash flow at the moment is currently about 30, and that's because it's had kind of a windfall negative effect this year in its cash flow due to exceptional items like acquisition costs, and it's kind of ramping up its acquisitions quite a lot recently. But on the whole, it follows earnings. I think that it will remain cash flow positive, and it's very cheap at the moment, and it currently had its best year ever due to the bumper year in 2021 advertising as an industry. It's the second largest TV broadcaster in the UK, just behind the BBC. And the last point, I won't go into it too much because it's quite detailed, but basically they have what you would call a defined benefit pension plan. For those of you who aren't familiar with that, it's basically the company promising you money in the future when you retire, which effectively creates a liability on their balance sheet. This isn't common of corporations today, but public broadcasters and I guess companies which are quite tied to, I guess, government services as well, the defined benefit system is quite common. But the problem with it is it creates a liability, as I say, a liability on the balance sheet. And it makes the cash outflows from this quite unpredictable because it's kind of hooked to market conditions like interest rates and inflation. And it's currently involved in a 130 million dispute with the pensions regulator in the UK, so it could be potentially paying out that amount quite soon. So just looking at the TV market, so I mean, it's pretty obvious to probably most people in this room, but streaming services have, of course, become, a lot more popular, and particularly for the younger generation. Most of us probably use Netflix or Apple TV or Amazon Prime, or at least one of those. And as you can see, the overall curves of the popular streamers has, of course, gone up in terms of the penetration of UK households. Just to note, in terms of the terminology as well, SVOD or SVOD means subscription video on demand, which is just a fancy way of naming these subscribers. So of course that that poses a threat to ITV because there are fewer eyeballs on their on their television and on their programs. And then you look at advertising. So again, as I mentioned before, it's almost 60% their revenue as of 2021. You can see here, if you just look at the green bars here, you see that online advertising by far dwarfs the bottom line here, which is TV. So of course, there is a threat there and a need to adapt. However, despite the sort of slight decline in TV advertising, I think that the company can still make enough money to warrant what you're paying for it now on the London Stock Exchange. And then the third part of it is production.
Now, I spoke before about ITV Studios and how it's going to become a pretty pivotal part of the business. So currently the biggest markets for TV production in the world is the US by far, followed by a distant second, which is the UK. And that's purely, I would say, from my personal experience, due to culture. You know, Western media is very, very popular around the world. And, you know, you can see here that obviously the overall production sector revenues are sort of flat slash, you know, on the up. And you can see in the UK, you know, most of the spend has been on the UK, of course, but then there's also been a significant chunk internationally as well, which is good for ITV because it means it can make money outside of its own domicile. So where are they going? What's the future of this company? How are they going to survive? Well, they've got their more than TV strategy, and a part of this is launching a new service called ITVX. For those of you familiar with ITV products, it's basically bunching together ITV Hub and BritBox together. So it's effectively combining the advertising and subscription-based model together, and they're claiming that they can basically upsell the people who aren't currently paying subscriptions for their services to make them pay subscriptions eventually. Whether that's going to happen or not, I can't predict that, but it's certainly, you know, a step in the right direction. The second point here addresses demographics. Now, it might not surprise you, but it's worth pointing out that older consumers watch way more traditional television, live television, than younger consumers. And you know, this is staying pretty steady, I guess, for the older population. But obviously, the younger population, for advertisers, it's getting hard to reach them via traditional TV methods. And so it begs the question as to whether advertisers are going to be willing to pay for more expensive, what you would call inventory, because there are fewer people watching these programs, in order to reach that audience. Now, I would argue, even if they don't reach younger consumers, that doesn't matter, because the older consumers, even though they're only 32% of the UK population, they control 60% of the wealth. So advertisers are still, in my opinion, going to be willing to spend that money, which ITV is going to benefit from, in my opinion. Then the last point is just talking about the production licensing. So as I've said before, I don't need to go on about it again, but you know, their content is massively popular around the world and in other English-speaking countries. So I think there's going to be, you know, still solid demand there. Now, just looking at, I guess, how this is all reflected in ITV and the market figures, you can see that, as I alluded to before, if you look at the bottom lines here, this is the younger population. They're watching significantly less TV than they did 10 years ago. However, for the older part of the population, that remains a slight decline, but still relatively stable. And this is obviously reflected in ITV's total viewing as well. So about 17 billion hours in 2016, now just down to just over 15 billion. Now this is quite interesting because this is talking more about their streaming services and their less traditional ways of consuming television. You look on the graph on the left here, this is talking more about their subscription services. So this is, you know, basically people are paying monthly for watching their content. And you can see, you know, there's a huge increase there from just over 500,000 to 3.5 million as of 2021. And this is also this is mostly driven by international subscriptions. So that's why that's going to be, you know, quite an important part of their business. Then you look at ITV Hub, which is a free but ad-based platform. Their viewing's gone up massively, which just shows that consumers are tending more to watch TV online, as we've already seen. So how much is the company worth? Well, there's a few forecasts I've had to make, obviously, because for those of you who are new to investing, the value of a company is pretty much dependent on the amount of money it's going to make in the future, discounted backwards. So in order to, you know, calculate how much money it's going to make, you have to make some forecasts. So the first thing I've assumed is that traditional TV advertising spending is going to decline from 4.5 billion in the UK to about 3.5 billion by 2030. And ITV are going to retain 35% market share because of its strong position as a public service broadcaster. It's very much embedded into the country and into the market. And as I alluded to before, I think advertisers are going to have a strong propensity to still reach those older, wealthier consumers, which is going to keep the demand up. Streaming revenue will peak at 9% of total revenue. I think it's about 2 or 3% right now. So by 2028, that's going to reach that peak. And almost a third of total advertising revenue will come from non-traditional methods of consumption. So in this case, ITV Hub or ITVX in the context of its new strategy. And that's massively important because it means that it remains relevant in the advertising space. It's currently only at about 3% now, but it will be at around a third later on in the decade. And then studios production revenue, so it's had a massive uplift at the moment because of the popularity of its content and its investment in content. But I think that will probably mature by 2026. And it will also have hindered profitability. But something I haven't spoken about thus far is the profitability. Currently, certainly in the TV production industry, it's getting harder for ITV and other competitors to hire people. And this is obviously, macroeconomic factors, inflation, wage inflation. We've just seen one of the hottest labour markets ever over the last 2 years. And, that's not exclusive to studios, but what's effectively happening is getting harder to hire freelancers, which is going to decrease profitability. I've already talked about its pensions as well. So I've assumed that the fine is going to be paid next year, and it's also going to be, sorry for the acronym there, that means LDI means liability-driven investing. That basically means that it's doing well to match its liabilities for its pensions, so it's going to have less unpredictable cash flows, which makes the business less risky. And overall, I think it will have lower profitability because advertising is going to become, I guess, less of its business. And then the model assumptions, won't talk about this too much, but basically, as I alluded to before, you've got to discount the future cash flows in order to value the business. I've assumed a 12% discount rate based on a CAPM model. That stands for Capital Asset Pricing Model. That's basically, a fancy way of crunching some numbers together, all to do with the, current interest rates and risk of the business, and then coming up with an overall risk figure for the business, which in this case is 12%. And then terminal growth rate's 2%. So that basically means how, after a certain period of time, how much the business is going to grow forever. And then its tax rate is slightly higher as well because we've got some impending fiscal tightening, as we all know, in this country. And then its pension funding commitments remain as is. So this is what I've projected for the company. My projection spans from 2022 all the way to 2030. And basically, we can see a slight downturn in 2023. That's due to its decrease in profitability of production sector and also its payment of the fine. We can see that it sort of slightly recovers and then comes back to the 600 million mark. So how much is the company worth after all of that? I'm predicting that the company's worth about £1.27, which at the moment is about just over 50 pence more than it's currently trading at, which is about 60-70% upside. So well worth it. And just finally as well, on the valuation side of things, I've produced a graph which basically, in my opinion, measures the margin of safety. So what this graph shows is that the intrinsic value, i.e. the value of the company, tends downwards as the discount rate goes higher, which is not surprising because the higher the discount rate, the more the future cash flows are discounted, the lower the value of the business. The reason I've done this is because when you value a company, all valuations are wrong, but it's just about being less wrong than the next person and being right enough to make money. And effectively, what I'm telling you here is that even if my discount rate of 12%, if we just look there, it's a bit small, even if it's wrong and maybe it's up to 15%, the stock is still undervalued. So the only way it can be overvalued is if we pass the discount rate of 21%, in which case it's not worth investing. Now, for those who are quite new to this, 21% is quite high for a publicly traded company, and in my opinion is unlikely to go to that.
what about, sorry for interrupting, just to
Yeah,
make
go
you
ahead.
some, what about bad scenarios, like in terms of looking about your margin of safety? Do you account for bad scenarios, like, okay, that even with this 20%, if the assumptions are sometimes don't happen as they should, like just this, like, sorry for the interruption.
No, it's fine. Yeah. So I haven't actually done scenario analysis. I guess this is maybe a cheap way of doing that. But yeah, of course, there's certainly a possibility of that. And, it's risky. And if nobody wants risk, then we should all just invest in bonds. But yeah. So finally, I'll talk about risks. So obviously, I've talked about the pension case. Significant moves in interest rates, inflation affects that, so it might affect their future liabilities. However, this is mitigated by their investment strategy, all to do with their pensions. Obviously, you've got the cost of living crisis, although this could work in ITV's favour because most of its business is free to view. And then you've also got, as I've spoken about before, secular cost increases in the production licensing space. So many contractors during COVID actually left, and it's difficult to get them back and difficult to bring on new starters, which is resulting in sort of 10 to 25% cost increases. So that's also a big risk. And just looking at its recent performance, so it's been absolutely killed this year, but just in the last 6 months, you can already see it's already going in the positive section. Annoyingly, when I started analysing this to now, it's actually gone up 43%. So if there's any time to get in my opinion, it's now. And that's it. The full piece on this will be out within a week. If you'd like to have a look at it when I release it, then please scan. My blog is the Sunrise Investment blog, and thank you for listening.
Thank you very much.
We can take 1 or 2 questions, but not more, because then we can discuss everything when we finish. But 1, 2 questions, we could get just 1, 2 questions quickly. Is anybody that wants to ask something, or should we move to the next presentation? Okay.
Hi, thanks for the presentation. Quite good. The big point I find is that the company's facing a lot of challenges to for a growth outlook. Of course, we can see the cigarette butt method of Warren Buffett, where you tend to invest in companies where you have a good margin of safety. But in this particular case, I find it challenging to see that how the company has an opportunity to grow the market share, or in positive sense, how the investor can be sure that my money would be safe for next a 5-year period.
Sure, no, that was a really good question, and it's important to look at the growth outlook kind of specifically for a company that's facing the threats that I talked about before. I think my answer to that is it doesn't really have a glamorous outlook. It doesn't really have it's not a high-flying growth stock, and I think it's in the next 5 years it will still be plodding along, certainly, but I think with the price it's currently trading at, I think it's still well worth it. If you're a growth investor and you're buzzed by new ideas or companies like Apple or Tesla or whatever, then this probably isn't for you. But if you're just interested in making more money in the future than you're paying now, I think that this is, well worth it. And if I was told that a company that I'm investing in is going to go bust in 5 years, and I've invested 100 million, and over the next 5 years I'm going to make $1 billion, I don't care if it's going to go bust, because I'm going to make $1 billion on top of my 100 million. So I know that's a bit of an extreme example, but my point being is that it doesn't have a glamorous outlook, but it's, in my opinion, still underpriced.
One more question, and then we can.
So I find the valuation quite optimistic, because especially for a company which makes about 60% of their revenue from advertising on the cable TV, don't you think the cable TV business is going to be an obsolete industry going forward? All these, companies like Netflix and Amazon Prime Videos, they're going to flourish in the future. So I find that 2% terminal growth estimation quite optimistic. And obviously, once that happens, I think that the advertising revenue is probably going to go down in the coming future. So that's when the company's going to struggle.
Guys, yeah, okay.
I'll be very quick. Yeah, no, that's a great question. I think that, yeah, the advertising revenue is going to go down, and that's why it's going to become less of a percentage of total revenue. As I alluded to before, the ITV Studios business, which actually, I didn't show it on here, but the percentage of studio or production revenue that's coming from streamers has increased significantly over the last few years. So that offers, some level of protection. I guess you could say that the traditional advertising space that ITV is in is maybe a bit more of a cigar butt play, i.e. it's in its final stages, but it's still going to, I think, knock out some level of cash flow that's worth paying for today, in my opinion.
So they should have a transitional plan in your growth or your investment horizon, depending how long it is. So your risk is looking like DB pensions, but within the last 10 years, it's probably transitioned to DC anyway. So that's going to be that's have a limited life. We're going to lose that liability. It's going to reduce. Their transitional plan into other mediums of making revenue and growth will be potentially positive. So, are you reducing risk and increasing your growth opportunity through their business plan? I don't know what their plan is.
Yeah, no, I agree. And they're actually phasing that out as well because they've stopped taking contributions to their defined benefit pension anyway. Anyway, I think that's all we've got time for, isn't it?
All those discussions are great, and we can continue later, but we don't want to steal time from the next. So, thank you so much.
Can you see the pointer? Somewhere?
Point. I can't see it.
Yeah. So, okay. Here.
Just give me a minute.
So our next speaker is Ildar. He will talk about Volkswagen. Ildar has been working in the financial markets for 20 years. He's very experienced, including corporate finance in buy-side and sell-side equity research. He's an active bottom-up investor, and he has recently launched his blog, Hidden Value Gems. I'm one of the subscribers and one of the fans, and I like that he talks also about philosophy of investing, and those things are always interesting. Even if you know some of them, always the repetition. So please go and check the blog. Is great. So Ildar, please come.
Thank you. Thank you. Hi everyone, good to see so many people. Yeah, it's my first time presenting at this event. Hopefully you'll find it interesting. So should I use the pointer?
Yes, please, yeah.
Yeah, there are a couple of charts.
If it doesn't work, I will fix it right now.
Yeah.
It should work now.
All right. Yeah. Before I go into Volkswagen investment thesis, I'd like to spend a couple of minutes on what makes my approach. And basically, I'm looking for great companies. And the idea is that once you own a great company, which has a great product, great management, you can achieve very good results. And the idea is that here is a company with $100 in capital. If it makes $30 profits, that's 30% return a year. If you hold it for 10 years, your return over the next 10 years will be close to about 10 times. It will the price you pay will matter, but the longer you hold, the less relevant the price you pay for. The problem is that it's very hard to find businesses that are actually available at good prices. So that's the kind of the flip side. And going a bit further, there are basically two types of investments I consider. One is the first type, which is a great company as long as you don't overpay. So the main advantage is that it's actually very tax efficient as long as you don't sell it. It gives you peace of mind because you don't have to chase, every 6 months, every 1 year for new ideas after you sell the previous one. So you can be quite passive in a way. You just hold it, like say Amazon, if you've been smart enough to identify it like 20 years ago. And but there are of course disadvantages because really great companies there are very few. The other approach, which is more like cigar butt approach, coined by Buffett, is basically you're trying to find dollar bills for 50 cents. You can achieve much higher returns if you are lucky with finding these businesses. It's much more kind of number driven, so you can do much more research at home. You don't need to study the product that much, but you may have to pay higher taxes because you will be selling more often. It's also very competitive because you have so many computers, so many databases these days. So to find cheap stocks, it's in a way it's a no-brainer. So it's hardly an advantage if you see a low P stock. Very often it is a value trap. So now this is the main theme of my presentation. So Volkswagen shares. So this is more of a type 2 investment, which is more of a cigar butt. So what's the price of it? So let's start with the basics. It's about 85 billion in euros market cap. There are two classes of shares, common and preferred, and there are different prices, as you can see. Now, what you get in return? So if you buy the whole business, $85 billion euros. Sorry. So you get a stake in Porsche, which the business which was just listed about a month ago. The value of Volkswagen shares in Porsche is about 68 billion euros. The whole market cap of Porsche is bigger than Volkswagen. You have net cash at the Volkswagen Automotive division. It does not include financial division, which is about 24 billion euros. You have IPO proceeds, so the stuff they sold in Porsche, 9 billion, and another 10 they will collect from the parent of Porsche. I will speak shortly about the ownership structure. So it's like $20 billion from selling down their 25% stake in Porsche. On top of it, you have essentially a bank within Volkswagen with a book value of 40 billion euros. And you have to deduct hybrid capital and IPO costs. So in net, you get negative 50 billion valuation, which means that essentially not only you get the core business outside of Porsche for free, but you get it at a negative value. So it's almost like the market asks you to pay. Actually, will be paying to you for holding Volkswagen. The other good thing is that the company is not just sitting on cash. It's not like idle cash. The company will be distributing. So it pays regular dividends, but it will also pay a special dividend. So 49% of the proceeds from Porsche IPO will be distributed as special dividends. It's about 19 euros per share paid in early January. So it's about 10% yield if you buy ordinary share, about like 13% if you buy preferred share, and taking into account regular dividend of about 10 euros, you are about to collect think about 20% within like 12 months or less, just in dividends. Now, this is the corporate structure. It's a bit complex, but the point is, so here is in red, we circled in red the Volkswagen Group, which you can buy both common and preferred shares on the market. It does own 75% economic interest in Porsche AG, which has 86 billion euros market cap. It is owned by, so controlling stake in Volkswagen is with the Porsche entity, which is also listed. You can also buy it, but I think it has much bigger exposure now to Porsche, so I'm not, I think Volkswagen is more interesting. And the entity Porsche SE is controlled by Porsche and Pio families. There is also 20% stake of the regional government of Saxony, Lower Saxony, and Qatar Holding also owns about 17% of the votes in Volkswagen. So you essentially, the free float is about 46% economic interest, only 30%, just under 13 votes. So your minorities do not have much say in this business. That's the downside, I would say. But so the stuff that is not listed directly, so it is under the Volkswagen Group on the left. These are all the brands other than Porsche. They generate revenues of more than 200 euros revenues, EBIT of about 15 billion, and free cash flow of about 5. That's on last year numbers, which were also pretty stronger than usual. Just in short, what is Volkswagen? So it's the actually the biggest car manufacturer by sales in dollar terms. I think it's first or second by number of cars sold, just above Toyota. So it is real large. So these are the main brands that most of you will know. So it's unlike many other companies. It's present in key segments. So it is in the volume, in premium, like it is competing with BMW, but also it is in the luxury business, which I think is completely different. So the less you produce, the better, and the higher the price, the better. It's phenomenal economics, and they own at least 4 brands in that category. And then they have also commercial vehicles and trucks. By the way, there is another entity which is listed, but it's in the trucks company. But I'm not going to talk too much because it's relatively small given their scale. One thing I want to mention, because auto industry has a negative perception, but I think one big advantage is the mode. So it's not easy, even if you have a lot of money, to reconstruct the industry. Say you are in Saudi Arabia, you want to build a brand new plant. You can't just do it. You need a lot of supplies, you need software, you need all kind of components. And that's the advantage of the German auto cluster. So it's not easy to replicate. So there is a bit of a competitive advantage, I would say, even though in general it's a highly competitive business. And this is just to further to confirm the point, the ecosystem, the buzzword, it's pretty complex actually. These are just some numbers about sales. So it's about, I think, 8 million cars they sell annually. Okay, this is real complicated. But the point, so the point here is it only about the price? So is it only about the negative value? So what if you buy the business and the market continues to be negative, like it doesn't want to re-rate the business? My idea is that, okay, in that case, you end up owning the business, and your returns will match returns of the business. So if the business is growing over time, as long as the valuation multiple doesn't change, the share price will reflect it. So has the company been growing? And I think that's important. The answer is yes, at about more than 6% per year for about, I think, 15 years. Net income has increased by 10%. What I really like about this, if you go back in 2008 and 9, the period which we quite often referred to now, given the crisis on many fronts. Yeah, actually, it remained profitable. So it generated 4 billion or more than 4 billion in 2008 and just under 1 billion in 2009. It's been free cash flow positive for most of its history. I'll move to next slide. This is how they've been allocating capital. So they've been paying regular dividend, not sitting on cash. They've been growing their net cash position by about 5% per year. So quite often the value trap is that they show you a profit, but there is negative free cash flow, or there is a cash drain. They have to raise debt all the time. This is the reverse. They are profitable, but they're also generating extra cash. One thing I'd like to draw your attention to is the share count. So the very two last bottom lines. It's quite interesting that the ordinary shares remained essentially flat. This is the voting shares, while preferred shares have gone up by 5% per year, but it's more like they doubled basically in 15 years. So the risk of dilution is much higher in preferred shares, and I think that they are trading at a discount that may reflect this risk. So I personally bought, I think a week ago, both common and preferred shares. I think it's safer to own both type of shares. This is how they historically were valued. On average, it was about, I think, 10 to 12 times PE, although it was boosted by 2008 period. And on average, I think the dividend yield was about 3%. So right now you can collect almost 20% dividend yield, and it's trading at about 7 times blended PE. So what could go wrong? So these are the questions I like to ask, and I think generally you lose money in two ways. Either the product becomes obsolete, so no one uses it, like think BlackBerry or Palm Pilot, if you're old enough to remember that, or there is too much debt, especially if it's a commodity cyclical company. So with the first one, of course, the biggest challenge is EV, like will they be successful in transition? Will Tesla disrupt them? And this is a super complicated question. I don't think I have the answer. I just think that given their scale and given that they've been in the business for 70 years, they will probably be quite slow to die. So there is some room for them. And there is a separate strategy on electric vehicles, which they presented last year. So there is a plan. They're not standing still. And as for that, it's a net cash company, so I think that risk is pretty small. Sorry, I think I can't move to the next.
Okay, I will fix it now.
Yeah, there are 2 or 3 slides left.
Yep.
Okay, that's not the slide. Okay.
Yeah, I will find it now. Give me just a second. Where is it? Yeah, it's here. Show it. Yep.
Yeah. So there is a bit of pension liabilities. It's about, I think, 40 billion. There was this diesel scandal, like for many other companies as well. So you were paying about 1 or 2 billion euros per year as a penalty. It's largely over. I think this or next year will be over with the full payments. Although the risk is that there may be further follow-ups on that. The other risk is that they just overspend on batteries, on all these new generation mobility. It's also an advantage and disadvantage that there is no open control. So like if it's a deep value, no one can buy it because it's already owned, controlled essentially by Porsche. And it is a highly competitive industry, as you all know, I think. Sorry.
Why? Let me see. It should.
Yeah. Oh. Okay. So just the right moment. So yeah, you can follow me on Twitter on the website. Yeah. Maybe. Okay.
1, 2 questions you can get, man.
Yeah. Please.
Why would you prefer the preference share?
Because it's cheaper, so it's about 30% cheaper, so you get the dividend yield is higher. so yeah, you're gonna get better return, but the risk is that you don't. So if there is any further M&A consolidation, ordinary shares are better instrument.
Any other question? One more question. We could get one more question. Yeah.
What's their competitive advantage?
Well, I think there are maybe three. So the segment which I like the most is luxury, where basically, as I said, like the less the better. Like Bentley, you know, if you're rich, you want the price to be high, and it's a niche market. If you look at Ferrari, one of their competitors, it has a market cap of $70 billion. And it's very hard to create these brands. It takes like ages, decades. Like you can't, like a Chinese company will struggle. Maybe they can succeed in China, but in Europe or US, they will struggle. Within the main market, which is much more competitive, I think the main advantage is scale. So they are number one producer. And the other thing is they try to merge different platforms. So I think the big advantage is you need scale in this business, and they are located in Germany. Currently, it's a disadvantage because of the energy crisis. However, given the integration with other suppliers, it's basically like an ecosystem. Like it's very hard to replicate. Like with all the scientists, like okay, maybe in France, but not really. Maybe Italy, US, Japan, but there are very few places where you can do it at such a scale. So. Yeah, and actually, I wanted to add one more slide, which I forgot. So, like, great companies, you really want to buy when there is some pessimism, some issues. And if you think about the region, so there are two regions currently which everyone hates. One is China, although things seem to be improving, at least based on the headlines news. And the other is Europe, given the energy, the Russia, etc., Ukraine. So from that perspective, it's quite a contrarian, and I think that's the opportunity. So hopefully in 2-3 years, when things settle down, that would be how you make money. There is a disclaimer, but I'm not gonna bother you.
So here we have Mikel Bastida, who is an individual investor, but always interested in learning. And he also tweets us at Mikel. You can see how it looks at our page, okay? So yeah, you can. I didn't know that you have a Twitter account and you're so active, but now I'm following you, okay? Okay.
Very good. Thank you. Yeah, like Dimitri said, I'm an individual investor, and it's my first time doing a presentation. So yeah, there's a lot of things I want to say, so I'm going to be rushing.
It will work in a minute. Just give me a second. Yeah, now it should work.
Which one of you know S&P Global? Standard & Poor's? Or half? Okay. Just measuring. Well, it's a company that has recently acquired another company, which is called IHS Markit. And this is at the time was a huge acquisition, 44 billion. And this has been completed in 2022. So now we have a combined company that is 115 billion market cap and did around 12 billion in revenue last year, more or less. It was a little bit more because it had a very good year. This is already the pro forma revenue after the two companies have combined. And the headline this year is that the ratings, the credit ratings that they do, they are severely disrupted. They are forecasting that the revenue from the credit ratings, that is the biggest part of the business, is going to decline 30%. So in this presentation, I'm going to show you what this company does, and to show that I think this company is much more resilient than it appears in the headline. So, I can't go through the story because there's a lot of things, but what you need to understand is that this company was for a long time inside the McGraw-Hill company, which was an empire of printed media. They were acquired in the 1960s, Standard & Poor's, and they wrote the boom and then the decline of printed media. And around the 2000s, the printed media started to decline, and the financial part of the business became much more important. And then on top of that, on 2008, they did the credit ratings on the CDOs, and then they were accused of the great financial crisis. And on top of that, they downgraded the debt of the United States government. So yeah, they got into a lot of controversy. And what happened is in 2013, there was an activist investor that came and said, please divest all the printed businesses you have left and just keep the financial business because it is the biggest part and it's the highest margin business. So they did that, and in 2016, they were renamed as from McGraw-Hill Financial to Standard & Poor's Global, and now we have, in 2022, that they have merged with IHS Markit. So I'm going to go by segment because now it's a company with multiple segments. And the first segment that you want to know about is ratings. As you can see here, it's 4.1 billion in revenue, and last year they did 2.8 or 2.6 billion in operating profit. But you can see that the margins of these are huge, and this is also the biggest revenue part. And in summary, for some of you that maybe don't know, what's a rating? I'm going to make you as a short lesson. So the credit rating is the assessment of the ability to pay a debt, and this is called credit risk. Standard & Poor's Global does this for governments, businesses, and then for some structured financial products. And this is paid by the person who wants to get the rating. And this has approximately 0.07% of the cost of the quantity that you want to borrow, or 7 basis points if you want to call it that way. And what you want to know about the credit rating agencies is that there are big three. There are Standard & Poor's, Moody's, and Fitch. And Standard & Poor's and Moody's, they are the most likely to be the top two of any big even category that deserves a rating. And they are leaders in the US and Europe. And more or less the rest of the competitors in the credit ratings are negligible. So they could come and offer a lower price and nobody would take it. They will just take the top two, which are Moody's and Standard & Poor's. And the interesting thing is that the largest two, they operate as a duopoly because they are not competing. Because actually, most of the companies get two ratings. So they just get the rating for Moody's and Standard & Poor's, and because they have to get the two, they don't have to compete in price, which is a very nice position to be in. So what would a rating do to a company? Let's say a company wants to borrow $200 million over a 10-year period. If this company doesn't have a rating, they may get 5.4 interest rate. And if they get a rating, their interest rate drops to 5%. So over a 10-year period, they will be paying $8 million more in interest. So does it make sense to buy the rating, which will be 0.07%? That means 1.4 billion, 1.4 billion for S&P Global, 1.4 billion for Moody's. Will they pay this? Of course, yes. And on top of that, ratings allow the credit markets to work. The investors are aware of the risk, so they can price the debt. Since these two companies give all the ratings, there is the benchmarking that you can compare companies across ratings, and then over a given time, like in history, you can say, oh, companies that were rated this way had this percentage possibility of default. And this is very important for the market. This gives more information to the market, which makes the market more liquid. And then due to compliance reasons, that certain funds or certain companies are not allowed to purchase debt or securities that are rated like above this because they would be considered risky. And this, in general, creates a network effect that the entire fixed income market is built around the ratings. And the companies have no choice but to pay. And this is why they have huge margins. The moat that they have is the regulation. So the regulations are so strict that basically no competitor is going to enter this part of the business. There is trust because they have been doing these ratings for decades and decades. There's the network effect that I explained, and there's the value proposition that actually, on top of this, it makes sense to obtain the rating. You will pay upfront, and you will have a lower cost of capital in your company, which is great. And you can show it, you can measure it, because you will get a lower interest rate. They are the plumbing of the financial system, and that's the thing. Like, this is the part that is suffering this year because the revenue is recurring and transactional. Transactional means that when you want to issue debt, you pay for S&P Global, and this is what is the transactional revenue is in Q3 is minus 65% year over year. But the non-transactional revenue is only minus 6%. This is continue assessing the debt over its maturity, so until its maturity. So long term, this has been resilient. They were accused of creating the great financial crisis, and here they are. They are still alive. They are non-capital intensive. They just have to pay people to make these ratings, and just pay offices for these people to work in, and that's it. They are exceptional in all metrics, margins, returns, and I think it's interesting to own this because if you look beyond this pause in the market that nobody wants to take debt because the interest rates are so volatile that companies are waiting to issue debt to see where this settles down. I think this is now perhaps a good opportunity to look at Standard & Poor's Global. So the second part is market intelligence. This is a lower margin business. They just get financial information, and then they resell it to financial institutions, investment managers, banks, etc. They also take the ratings that they did, and they resell them, which is great, because you don't have to pay for those. You just create them yourself, and somebody pay for them. And because they now combine with IHS Markit, it's interesting because the IHS Markit business that they combine with it has higher margins. This Standard & Poor's Market Intelligence was a lower margin. So because there's a customer overlap, now that they combine these two businesses, it's good because although Standard & Poor's had lower margins, they have a wider customer base, so now they can take the data that they have from IHS Markit and try to sell it to the wider customer base. And I think this will be good from the merger because the data has operating leverage. You collect the data once and then you sell it multiple times, which is also great. And with this and pricing and changing the way people pay for these services, I think there's an opportunity to improve these margins that were in the 30s, which I think are low. Next part of the business is commodities. You might think commodities is a bad business. Wrong. Wait until you hear about it. Because Standard & Poor's owns the pricing and insights of certain commodities. They basically own the price. And this is embedded into contracts, embedded into financial instruments, futures. And this is now combining with IHS, which has a more cyclical business because it's more for data for engineers and geoscientists, so it's more related to CapEx. But this is much less cyclical than the underlying sector, which is commodities, and has 45% margins, which I think is crazy if you consider the underlying sector that is paying for this. So Standard & Poor's were number one on pricing. IHS Markit was number one on data. I don't know why the regulator allowed this to happen, but now they have become a very huge player on the commodities industry. And over time, so data and analytics becomes more valuable, so I think this is a good business to own. And then they own indices. So you've talked about the S&P 500 index. So S&P Global owns this. And you can think about this don't think of this as like a financial business. Think of this as intellectual property. You own the Standard & Poor's index, which is a huge brand. And this generates royalties. So whenever there's an ETF that is tracked to the Standard & Poor's 500, they pay a royalty to Standard & Poor's Global. and and the thing is that this is intellectual property, but the end user chooses the index, doesn't pay directly. You just go to buy an ETF from the Standard & Poor's 500, and you don't bear the cost. You don't see that what you are paying to Standard & Poor's. And actually, if you see BlackRock and these companies that issue ETFs, so they are also making a lot of money. This is a relationship that is lucrative to both of them. So I don't think this is going to happen. Of course, it's a very valuable asset to have when passive investing is having more inflows and inflows. This is a trend that I think is going to continue. So I think this is another great business that has margins around the 70%. It's another infrastructure type of asset. Passive investing industry is built around them. The regulator prevents self-indexing, so BlackRock is not going to play the BlackRock index. There are regulations around that. You just capturing a small percentage of the value. There are trillions linked to the Standard & Poor's 500. They just have to collect a very small percentage, and because these quantities are so huge, they end up very high incremental margins as well, because you just don't need to create anything. You just own the index, and this is linked to assets under management, and there's more assets under management, and then your revenue goes up. And this is interesting because they are combining with IHS Markit, which is a much smaller player in the indexes, but they own indexes in fixed income, something that the Standard & Poor's didn't have. And they have pricing for, so one of the businesses of IHS Markit is they have pricing for fixed income, which is very good because these are very illiquid businesses. And then the rest two, I'm not going to talk about the other remaining two. One of them is 1.2 billion in revenue and 40% margins, and the other one is legacy IHS business. So overall, now the combined company has 75% of recurring revenue and has quite high margins. So I think this is a very business to have. So this is an overview of what we saw until now, the margins. And what you want to see is that I think all of them are not very cyclical, in the sense that they are still growing this year, but of course, ratings is severely affected. It's going to decline around 30%. And so here a lot of graphs, how this perform over time. The 2008 crisis didn't affect S&P to commodities, to market intelligence, and to indices. All of them grew in revenue. Only the one that is more cyclical is ratings, which declined in 2008, I think in 2018, and it's going to decline this year. But I think over time, if you look at this, these companies will still require ratings. This is just the cycle is turning against them, because that's what cyclical companies do. And I think it's very important that, look, I don't like when companies acquire other companies. This usually ends very poorly. But IHS Markit sold itself to S&P Global with no premium. They just gave a 5% premium. It was an all-shares merger, then the share price go down, and the premium disappeared after market, like in minutes. And the founder of Markit, which owned this business, he was 58 years old. He didn't have any reasons to sell. I don't see any. Why would he sell his company for no premium? I think the only reason why this person would sell is because he thinks that there's a significant value creation in this merger. And there's, on top of this, there's something I haven't told you about because it's not a segment of IHS of Standard & Poor's Global, but this ISG and climate. And this is not a separate segment, but this is an area that S&P Global has identified as an opportunity area. And for example, MSCI, which is the competitor in this area to S&P Global, has said that ESG is so important that they are going to already show it as a separate revenue line. And they are kind of similar, MSCI, you know, the MSCI World Index, so they also do indexes like S&P. They also do data analytics like S&P, and they also do ESG assessments like S&P does. So they are kind of similar businesses, and they both have MSCI ESG revenues were growing 49% last year. S&P are growing 52%. They are not the same. They are not one-to-one the same, but they are identifying that this is an area of emerging revenue and that this is going to grow more and more. And if you think about it, of what S&P Global does, they do ratings. It makes sense that they want to do ESG ratings because the institutions want it, the companies want it, there is more and more demand. The thing that is not there, that there is in ratings, is that you get lower cost of capital. You currently don't get lower cost of capital from having these ESG ratings, but if this was the case, then this will make a huge difference because it will give pricing power to a Standard & Poor's Global, and then it will be another one of those things that starts very small and then becomes a very meaningful part of the company. So why I'm pitching S&P Global now, someone is going to say this company is expensive. It is. It didn't decline so much as the other two companies, but I think it's a company that you want to always to own because it's such a high quality company. So in 2021, they had a very low profile. They were acting very low profile because the regulator had to approve this merger, and I think a lot of people thought this merger was unacceptable just because the monopoly that they are getting is insane. I mean, it's obscene, if you ask me, my personal opinion. Now that 2022 is complete, so they didn't repurchase any shares. This is how they usually return money to investors. They didn't repurchase any shares last year because they were doing the merger, and they had to divest a few things because to get the approval. So now, this year, they said, "Oh, we're going to repurchase 12 billion shares, so $12 billion in shares." And although ratings is severely affected and the share price has gone down, this hasn't stopped them from repurchasing shares. So far they have repurchased 11 billion out of the 12 billion. They have repurchased 10% of a company that is worth 115 billion in 10 months, which I think is this is an incredible capital allocation, accidental market timing, if you want to call it that way. And I can see ratings guidance is a disaster. So Moody's and S&P are saying minus 30% revenue ratings. And if you see what they're saying in the call, like they say, oh, companies are waiting to issue more debt, etc., etc. But I think the bigger picture here is, will the outstanding debt in 10 years be more than now? And I think this is a very easy assumption to underwrite here in this thesis. You have the GDP growth, that more GDP, more debt. You have pricing power, so they have slowly, but they are increasing the amount of money they charge to rate a certain debt, and still makes sense because, like I said, you get lower cost of capital, and still it makes economic sense for the companies to get it. You get the recurring assessment of all the outstanding debt that there is. You get disintermediation. Like, for example, in the EU, a lot of companies were going to banks to get finance. If the European Central Bank stops doing this, the companies will have to issue debt. So there's a lot of disintermediation from banks to debt market. The emerging markets also want to tap international credit markets, so they need a rating. So I think there's a lot of opportunities. And they survived the great financial crisis, and they are now stronger. They are now even stronger because the regulators put more regulation, and what happens when there's more regulation, then that competition becomes even more difficult. So yeah, these were the margins before, and I think this is a story of ever-increasing margins, just because there are secular trends driving all the businesses that they have, ratings, commodities, market intelligence, ESG that is growing a lot. They were growing around 8% S&P Global before. The revenue, 7 to 9% for IHS market if you exclude the smaller businesses. And I think this is a company that you can buy. So now you ask me what is trading this. This is trading at 28% depressed free cash flow multiple. It's now trading at 28% ratings, minus 30% decline revenue plus costs of the merger free cash flow. This is the free cash flow guidance for this year. last year they did 4.5. They had the guidance was 5 billion this year without the merger cost, but now this disaster happened that the ratings is completely disrupted. But I think this is temporary, and they will eventually return to growth. And I think you don't have to make up very excessive assumptions to see a scenario where the free cash flow is going to grow. If you see the revenue synergies and the cost synergies that the management has set, I'm putting 7% growth, which is lower than they had historically. I think this is a kind of company that you want to own forever, but you have to be opportunistic when you buy it. So, and if you want to see some risks, of course, like I said, I hate M&A. I hate when companies do huge acquisition, but since they did this acquisition without premium, and there are two companies that have a lot of experience with M&A, I think it can go well. So yeah, I think I spoke a lot. Sorry for that. But there are still many segments. So yeah, this is the situation now. The main character of the story, ratings, is on fire. I took the meme of everything on fire and reversed it. So ratings is on fire, and the rest of the companies are growing revenue this year, and they're just chilling. And this is S&P Global right now. Yeah, I hope you like it.
Questions? May I have a question? Yeah. So you said that for great companies, we have to be opportunistic. Do you afraid that such a great company, if the fundamentals like earnings or whatever are about to, we are about to see them in the next quarters, that we might see like a situation like Facebook. So we might find like this company in its earnings power in 9 or 10 times earnings. So like somebody could buy this great business, but also like keep some power, like to buy more if things. Is it something that you are prepared for? Like that's your question.
Yeah, I closed it. Sorry.
Okay. So I think it's a very. I mean, since this company has been operating since the late 1800s, when they started getting financial information from railway companies, which was like the crypto of this time. Everybody wants to invest in railways. I think there is such a track record of all the businesses that it's a company that I think you can pretty much own without a significant risk. And I think if there was a risk, you will start to see it. It will not be something all of a sudden like, I don't know, Facebook, like Apple changes something on the way they manage ads, and then there's a sudden decline in all of a sudden. I think you would see the decline more gradually, just because the amount of time and money you will have to need to disrupt it successfully. I put here some. This is an interesting document. This is when Warren Buffett was interrogated because of the great financial crisis, and he was asked why he owned Moody's. This is a document that was declassified, and it's quite interesting because it happened 12 years ago and it's still relevant today. And he said, if you've got a power to raise prices without losing business to a competitor, blah, blah, blah. He says there's not many businesses where someone comes and offers to cut the price in half and somebody doesn't think about taking it, which he was talking about the ratings business, that you will not get a rating from someone if that rating is not going to affect your the interest that you will get. So I think overall you will have to you will more gradually see that something is going wrong. But of course, I mean, there's an opportunity that, for example, the whole ESG doesn't materialize. That is a high risk, although I don't know if the market is really pricing it. So.
Okay, we can take one or more questions.
So why would you buy this instead of Moody's or Fitch?
You cannot buy Fitch. You can buy Moody's, and you could buy Moody's, and Moody's is more concentrated into ratings, so it's a larger part of the revenue. So actually, if there is a recovery of the market, it will be perhaps a better company to own. The only way from Moody's, I'm a little bit concerned about their ambitions beyond ratings and what else there is to buy in the market, because by taking IHS Markit, you have already taken a very big chunk of the financial data businesses that they were out there. But Moody's is a great business, and I will 100% own it. I mean, for tax purposes, Standard & Poor's Global and Moody's behave so equally that you can just sell one and buy the other, and then given financial tax year, and then just swap them again after 2 months, and you probably wouldn't see any difference in your returns if you needed to realize some gains.
Looking at the chart of the price, it looks like it's matching the market itself, S&P 500, but the chart of the price is matching the S&P 500 itself most of the time. Why would it be better to own these stocks than the S&P 500 itself for you?
Well, Standard & Poor's Global has significantly outperformed Standard & Poor's 500, the same as MSCI has substantially outperformed the MSCI World Index, because I think I think companies. I think although it's obvious that this is a very high quality company, I think even they beat earnings, and even when I have read a couple of theses there, for example, in valueinvestorsclub.com, and the pattern that I see when they were analyzing these companies is that they underestimated how much the pricing power and the earnings power was, and I think this can continue growing. I don't see a ceiling, but there could be as well. You don't have to buy it, but you can have it in the back of your mind if something happens and the price falls.
So guys, now we can socialize and talk with the speakers, and they fed us with great thoughts and ideas, and yeah, now we can drink and discuss about everything. Thank you for coming, and thank you for attending online as well.